We might get some suggestion from the IMF that it's time for central banks to be given a break and for fiscal policy to take the reins. Kallum Pickering, Berenberg Bank. Well, the IMF will kick off a week of meetings on Tuesday, with many eagerly anticipating the latest release of its World Economic Outlook. Growing risks of deflation, coupled with skyrocketing global debts, have been cited as reasons to why another downgrade is likely. Though what are you expecting?
Let's first make a point on deflation. Historically, inflation has been far more likely than deflation. And while there are some severe worries about deflation, as Japan has proved, a central bank can prevent deflation. Maybe they can't create inflation as they would like, but they can certainly prevent deflation, so that isn't a significant risk, but it does go hand in hand with global debt levels. Now, the more inflation we can create, the less debt becomes a problem. But creating that inflation seems to be a tough job in this environment between the Fed, the ECB, the Bank of England, the BOJ, and most other developed world central banks. They've struggled really to create inflation with their monetary policies over the last, say, 4 or 5 years. Now, debt is a good reason for this. When economies are highly indebted, they're less elastic to monetary stimulus and thus create less inflation. So I think what we might see from the IMF is a suggestion that fiscal policy should take the reins to try and boost nominal demand and create some of that inflation. Certainly where you have countries like the US, the UK, Japan, that borrow in their own currency and they have a central bank that issues it, modestly higher deficits and public sector debt levels would not create a surge in long-term interest rates and do any damage to private sector investment.
Okay, well, moving on. The US employment report comes at a crucial time for both politics and policy. The presidential elections in November are fast approaching, and the Fed have indicated the time for a rate hike could well be December. So, what are you forecasting? And crucially, what might this mean?
We'll probably get a number above 150,000 again, which is consistent with domestic demand expanding at a round trend and should put the Fed on a good footing to hike interest rates again in December. But what kind of strikes me about the US jobs numbers is they have been running consistently faster than gains in GDP for some months now. That implies weaker gains in productivity than in the past, which will harm profits. So the lowered profits mean that firms' demand for employment should start to slow. So eventually I expect a correction. The faster than expected jobs gains relative to nominal GDP gains means that eventually they will slow down. So we may get a downside surprise on the jobs numbers in the near term, whether it's this month, next month, or November or December. I'm not sure, but it will come eventually.
Lastly for today, which other key indicators will you be keeping a close eye on this week that have the potential to shape the markets?
I think the markets will mainly be focused on central banks. So the ECB will release on Thursday the account of the monetary policy meeting from the 8th of September. Remember, on the 8th of September, the markets took the ECB conference by Mario Draghi as a little bit on the hawkish side. That strikes me as a little bit odd. The ECB will probably have to extend its monetary policy by at least 6 months, and by that I mean I'm talking about QE, the 80 billion per month purchases. I expect them to announce that in December, so we might see when we look at the minutes, it's just some indication that the ECB Council was discussing that possibility. The second thing is the US. Of course, we have the change in non-farms. On Friday, it should be a number above 150, which is consistent with the Fed hiking interest rates in the near term. But we also get some other U.S. data, such as the ISM non-manufacturing and the ISM manufacturing, which comes out today. Markets will be looking at those as indications that the U.S. economy picked up from its August dip. Providing the U.S. economy does modestly accelerate in Q3 and Q4, which looks likely, and the jobs numbers are okay. the Fed are on course to hike again in December, so this will be a key week for market participants to eye up whether or not the probability of a Fed hike in December has increased or decreased.
Thank you, Kallum. I'm Sam Meredith, and be sure to check back to see how these market movers develop throughout the trading week. See you next time.